In Chapter 10, we're looking at accounting for long-term liabilities. And what we're going to spend most of our time on is bonds. And a bond is a type of financing similar to borrowing money from the bank or borrowing money from your investors, except bonds are different in how that they are set up. It is borrowing money, so this is money that you actually do need to pay back. Keep in mind, a note payable is money that you borrow and you pay back. On the other hand, if you think about your basic equity financing, for example, through the selling of stock, that is money that people give to you in order to have an investment in your company. You don't have to pay that stock investment back. Instead, what those types of investors are hoping for is that the price of your stock will rise and they can then sell the stock at a higher price, or they'll hold on to the stock and get dividends and things like that. So a bond is simply another type of financing, and it's a different setup than your typical note payable. The main difference is the number of investors and the size of your borrowings. So if a company wants to borrow, say, $100,000, they could do it by going to their bank and borrowing $100,000 from that bank. On the other hand, they could use bond financing. And the difference here is rather than borrowing money from the bank, you're going to be borrowing that $100,000 by borrowing it in small portions from multiple people. So rather than just borrowing $100,000 from the bank, instead an example for a bond would be to borrow $1,000 from 100 different people. In the end, you're still getting $100,000, but with a bond, you've borrowed $1,000 from multiple people. Now, typically, bonds are sold as $1,000 bonds. It could be different, but most examples that you're going to see are bonds being sold in $1,000 increments. And again, typically, bonds pay interest every 6 months. Now, it could be set up different. The contract could be different. Whatever the contract terms say is what will stand. But typically, what you'll find is bonds are sold in $1,000 increments, and they pay interest at whatever rate is in the contract every 6 months. Now, you don't pay the $1,000 back until the end of the life of the bond or the maturity date, but you do pay interest every 6 months. So you can see here, this would be the bond issue date. This is when you borrow money. And then down here, at the end of the life of the bond, you're going to pay back the $1,000. However, typically, every 6 months, you're going to be making your interest payments to your investors. Now, I also want to note that when you're issuing bonds, typically you have a large bank who actually does all the payments of interest and specific borrowings and dealings with your investors. It would be a whole lot of work on a certain company to actually go out and find all these investors, these, say, 1,000 investors or 100 investors, and then have them sign the bond contract, issue them a bond certificate, and then actually keep up with all the bond interest payments. Instead, typically what a company will do is if they decide they want to issue a bond, they will go to a lawyer or underwriter who helps put together the bond contract, and then they'll go to a large bank, whether it's Bank of America or TD Bank, but you go to a large bank that specializes in these type of bonds. They then go out and they find your investors. They do all the contractual things, getting people to sign and actually getting the money from those people. They then give the money to you, the company, and then you as a company will pay a large lump sum every 6 months to the bank, and that is the overall interest that you owe, and then the bank actually writes out those individual checks to the investors. So there's really a couple people involved. You've got the company who issues the bond, the bank who does all the busy work between the company and all the multiple investors, and then you have the people who have actually lent you the money. So why are these people willing to lend you $1,000? They're doing it for the interest that they're going to be earning. And we'll look into some other reasons why people would invest in bonds. And that depends on if the bond's rate is better than what they could otherwise invest their money in the market. And we'll look at that as we move forward. But there's some other things at play that we'll look at when we look at the interest rate that a bond is offering. That's what we'll be calculating our interest payments for, and what people could otherwise invest their money out in just the overall stock market, or if they're having some type of a certificate of deposit with a bank. So let's move forward. We've already discussed what your basic bond is. Again, it's simply a way to borrow money, but rather than borrowing in one lump sum from, say, a bank, instead you're going to be borrowing in typically $1,000 increments from a number of people. Now, when you think about raising money from a number of people, that also sounds similar to when we sell stock. But don't confuse bond financing with the selling of stock, because remember, when you sell stock, you're selling stock and someone gets a certificate of ownership in a very small portion of your company. Because they get that return in ownership, you do not have to pay stock back. So a bond is not stock. A bond is a note payable, so you do have to pay it back. So bonds do not affect owner control. Keep in mind, if it were stock, when you sell stock, rather than ever having to pay that stock back, instead you're saying that someone owns a piece of your company. So that is what they have bought and you don't have to pay it back. Bond financing, on the other hand, you're not giving anyone ownership of your company. Instead, you're simply borrowing money. So bonds do not affect owner control, and this can be a good thing because companies don't want to give up all the control in their company. Now, we've talked about interest. If you think about your income statement, one of your expenses on your income statement is interest. On the other hand, think about stock. You don't pay interest to your stockholders. Instead, you pay dividends. If you'll remember from the beginning of this class, dividends are not an expense. Instead, they're a reduction in your retained earnings. So, an advantage of having a bond is that the interest that you're paying is tax deductible. And what I mean there is interest is an expense, therefore it reduces your net income, and therefore because of that interest you're going to save a little bit on your taxes, because the lower your net income, therefore the lower your taxes. When you think about stock, remember, if you pay dividends, that's a reduction in your retained earnings. It is not an expense, so you don't get any tax benefit from your stock dividends. Now, when we talk about return on equity, bonds can either have a good impact on your return on equity by increasing your return on equity, or we can see a negative impact on your return on equity. And the reason that that can happen is you have to look at, if you are borrowing money, that is why you would be issuing a bond. So if you issue a bond, let's say at 6% interest, that's what you're going to be paying, is 6% of interest to the people that have lent you the money. Now, why did you borrow this money? I would assume if a company is borrowing money, they're going to invest it in some way. So if their investment earns 10% and they've borrowed it for 4%, that would be an increase to our return of equity, or our return on equity. Sorry, I think I said originally that this bond was issued at 6%. So if the bond was issued at 6% and they have an investment that's earning 10%, you're seeing that return on equity because you're making more with the money than what it cost you to borrow the money. On the other hand, again, let's say that we issued this bond at 6% and we carry forward, we move forward with some type of investment, but that investment does poorly, and let's say it only earns 2%. In that case, we have borrowed money and it's costing us more to borrow money than what we're actually doing with that money. So that could have a decrease in the return on equity. And then finally, remember that I mentioned that bonds are something that have to be paid back, and we have periodic interest payments that have to be made. So this can be looked at as a disadvantage when you're comparing that to stock, because again, stock, you don't have to pay it back, you don't pay interest. So when we're looking at bond financing or any type of financing versus equity, there's a kind of a give and take. If you finance things with equity, you have to give up control of your company. But if you're just using your typical loan or note payable or bond, you are borrowing money. So you're not giving up control, but this is money that you do have to pay back. So there's always the decision that has to be made about what type of financing are you going to use. Is it going to be equity financing, or are you going to incur a liability, which is something that you have to pay back? So when we talk about bonds, I also want to mention that bonds can be traded on the securities markets, very similar to the way stock is traded. And the way that bonds are traded is dependent on the actual value of the interest that a bond is paying. So let's say that a bond is paying, again, 6% interest. Depending on what someone could go out and otherwise loan their money for on the market or invest their money, the value of your bond would increase or decrease. So let's say the going interest rate on the market is 2%, then this bond is more valuable because this bond would be paying more, so it would trade for more expensive. On the other hand, if people could go out and invest their money for 10%, this bond, the value would go down, and therefore the price would go down, because people don't want to invest in a bond that pays 6% when the market is otherwise paying 10%. So when we talk about bonds, we typically talk about a percentage at which it's being sold. You can see here we have an example of a bond being sold at 121% and some change of its face value. And what that's telling us is that if a bond is a $1,000 bond, let's say that this bond is paying more than the market. So say the bond is paying 6% and the market's paying 2%. This bond is a premium. So rather than this bond selling for its face value of $1,000, instead it's going to be selling for more than its face value. And in this case, it's going to be selling for 121% of its face value. So 121% of $1,000, this means the bond will be selling for about $1,210. I'm ignoring the 0.18 just for simplicity, but you see how that works. We're talking about if it's being sold at a premium, and in this case, anything above 100% we consider a premium. Anything below 100% would be a discount. So for example, if you had a bond being sold at 95%, that would mean that a $1,000 bond is selling on the market for $950 because that's 95% of $1,000. So here we just have a basic example of a bond certificate. You can see who the bond is with. On here it would say how much the bond is for. You can see here this bond is paying 8% or 8.875%. And then you can see some more information about who the bond is with, what bank is actually doing all of the payments, and other contractual terms. On here you would see the maturity date and things like that. But this is just a typical example of a bond. So now we're going to talk about when we issue bonds. And I've already introduced the fact that when you issue a bond, you have to look at what percent the bond is paying compared to the market. We're going to begin with the most simplistic example, and we call this a bond being issued at par. And what I'm saying is a bond at par value is a bond that's being issued and it's paying the same rate as the market. So again, going with my example that I've been using, this would be a bond that the stated rate or the rate that the bond is going to be paying is 6%. If it's issued at par, that means that the bond is equal at this point in time to what the market is paying. So that means the bond is paying 6% and the market is paying 6%. So again, if this is a $1,000 bond, it would be selling at par or at face value. So it would be selling at $1,000. That's what we were talking about. If a bond is issued at a premium, that's where that percentage would be 121%. Or if it was at a discount, that's when it would be 95%. In this case, it's issued at par. So $1,000 bond is going to be sold at 100% or par value. 100% of a $1,000 bond is $1,000, therefore issued at par. So let's look at an example here. On January 1st, a company issued the following bonds. There was a par value of $800,000, a stated interest rate of 9%, and they've already told us that this is at par value. So the stated interest rate, or the rate that this bond is paying, is 9%. And we can also assume, because it's at par value, the market is also paying 9%. Our interest dates, again, I mentioned that typically you pay interest every 6 months. So in this case, we're going to be paying our interest to the investors on June 30th and at the end of the year on 12/31 or December 31st. We have our maturity date is December 31st, 2034. So this is a 20-year bond. Now, I also want to mention, we're looking at this from the company's point of view. Remember, to make things simple for the company, the bank does all of the work between all of the investors. So when the company is actually putting this on their books, they're not going to show a bond payable of $1,000 with 800 different investors. Instead, they would do the bond at the total amount that they're borrowing, and then the bank is the one who is actually going to go and collect the $1,000 from your 800 different investors. So again, to keep things simple, we're lumping it all together because we're looking at this from the company's point of view, not from the multiple investors' point of view. So in this case, the company has issued a bond. So the bank is giving them this cash, and they're giving them the full amount of the cash, $800,000. The bond payable is going to be sold at par, meaning face value. So we got $800,000 of cash, and we owe $800,000 of cash. Now we are paying an annual percentage rate of 9%. But what you need to keep in mind is we're paying that every 6 months. Remember, this interest rate is an annual rate. So when we're calculating our interest rate, we're only going to be getting 6 months worth of this 9% or 4.5% each 6 months. So let's continue on. On June 30th, the issuer of the bond, so the company who borrowed the money, pays the first semi-annual interest payment. So that's that first 6-month interest payment. Let's see how we calculate that. $800,000 multiplied by 9% multiplied by 1/2 of a year. So that's going to be $36,000. This $36,000 the company is going to pay to the bank. The bank is then going to issue all those individual checks to all of the bond holders. But again, the company is only dealing with the bank. They're not dealing with all the bond holders. So we're going to recognize bond interest expense of $36,000 and then the payment of cash for $36,000. We'll make this entry every 6 months until the bond matures. So then we're looking 20 years in the future. And now we're going to be paying this bond back. So someone has lent us their money for 20 years. In return, we have paid them interest every 6 months. But now we have reached the maturity date and we're going to give them their money back. So we reduce our liability. That was when we first had the bond payable. That's a liability. So now when we reduce that liability, because we're paying back the money, we have fulfilled our obligation. We do that by debiting the liability account for bonds payable for the full amount, and then we're crediting cash to show that payment of cash of $800,000. Now let's look at the idea of a bond discount or premium. We've already talked about the basic idea, but now let's actually look into this. So first we have our contractual rate, and that was in our previous example what we were just looking at when we issued at par. We said that the contractual rate was 9%. If we issue at par, the market rate at the time that it was issued would have also been 9%, and that was at par value. That's what we were just looking at when the contract rate equaled the market rate. But then what happens if our bond or our contract rate is higher than the market? This means that we are selling something that is better than what you could get on the market otherwise investing your money. So we have something that is better. If you have something that is better, you can sell it for a premium. On the other hand, if our bond is selling less than the market rate, again, just for example, let's say that our bond is selling at 9%, but then the market, you could otherwise invest at, let's say, 10%. So this means the market is better than what we're selling. If we're trying to sell an inferior rate, we're going to have to discount it. And we do that in order to get people to buy our bonds. So now, what do we even mean when we talk about selling something at a premium or discount? What we're talking about is that we want to borrow $800,000. If our contract rate is equal to the market rate, we're going to borrow $800,000, and at the end, we will pay back $800,000. Now that's going to change if we're selling at a premium or a discount. And what's going to change is the actual amount of cash that we're going to get. If we sell at a premium, we might be able to sell this bond and we get $810,000. But in the end, we only have to sell back $800,000 because we got a premium because we're paying a better rate than the market. On the other hand, if our rate is less than the market, we're going to have to discount it. And what that means is that we're going to get less cash in the beginning. So rather than selling for $800,000, we might have to sell it for $790,000. But at the end, we still have to pay $800,000 back. And that difference between the $790,000 that we got and the $800,000 that we're going to pay back makes up the difference between our lesser rate and the market. So let's look at issuing bonds first at a discount. So we have a company that's going to issue a bond. We have a par value of $100,000. We're going to issue at 96.454% of par value. Again, this percentage rate is less than 100%. So we know right away that it's being sold for a discount. So before we even get into the numbers, when we actually calculate what we're going to issue this bond for, it's going to be less than $100,000 because we're having to discount it in order to get people to purchase our bond or to move forward with our bond. So you can see here, this is why we have a discount, because our bond is paying 8%, whereas the market is paying 10%. We're going to be paying interest semi-annually. The bond is going to be issued December 31st, 2015, and it's a 2-year bond, a pretty quick bond here, and it's going to mature in 2017 at the end of the year. So let's go ahead and look at the issuance of this bond. So remember that percentage, 96.454%. That's telling us the percent of the overall par value that we're going to get up front. We're only going to get $96,454. You simply get that by multiplying the percent by $100,000. But keep in mind, the par value or the face value of this bond, meaning what we have to pay back, is $100,000. So we first record the cash that we get, $96,454, and then the bond payable, or our liability that we have to pay back at the end of the life of this bond, or the maturity date, is $100,000. Clearly you can see here the $96,454 and $100,000, they don't balance. So remembering the basic rules of accounting, you know that your journal entries or your credits and debits always have to balance. So what we need to do, you can see here, we need the difference over here on this debit side, $3,546. If you'll remember, we got less cash than what we have to pay back. So by rule, that is a discount. And that's what we call this account, discount on bonds payable. This is a contra liability account, meaning that it offsets our liabilities, or it works the opposite way of your liability. So let's look at what's going on here. We've issued a bond at a discount, so we have the maturity value and the carrying value. We'll use this carrying value to actually calculate our interest expense. However, this can be tricky. our actual payments are going to be based on this bond payable amount. And let's look at how we actually begin to calculate that. You can see here we have a bond interest expense. This is when we're paying our interest every 6 months. Then we're going to have an adjustment to the discount on bonds payable, and we're going to be paying cash. Now, the investors want to know from the beginning how much interest they're going to get paid. They don't care if this bond is being issued at a discount or a premium. They want to know ahead of time how much interest they're going to get every 6 months. So the actual cash payment is going to be based on the face value of the bond multiplied by our interest rate. So the cash interest payment is $100,000 multiplied by the rate of the bond, in this case 8%, multiplied by 1/2 because it's for half a year. So our cash payment for interest is going to be $4,000. However, what's tricky here is that the bond interest expense is actually going to be based on the carrying value of the bond. The way that we're going to do this in this class for simplicity's sake is we're going to look at the total amount of the discount. If you want to go back and remember, that discount here was $3,546. Now, how many periods do we have? In this case, we're paying our interest every 6 months, and this is a 2-year bond. So we have basically 4 periods in which we'll be paying interest. So what we'll want to do is we are going to amortize this discount over our 4 periods, and we're doing this using the straight line method for amortizing our bond discount. There's also the effective interest method, and that's covered in the appendix, but in this class and right now we're concentrating on the straight line method. So what this tells us is that we are going to amortize this discount. If we're amortizing, we are getting rid of this discount over 4 periods. So that's going to be $887 over 4 periods. Again, we're going to go back. What we're wanting to do is get rid of this discount. The way you get rid of a discount is by doing the opposite. So if originally this discount is a debit, we're going to be crediting it every time we pay interest. So you can see here, discount on bonds payable is going to be credited for $887. And then to make everything balance, our bond interest expense is going to be $4,887. So what you can see here, when we have a bond that is paying less than the market, we issued it for a discount. As we amortize that discount, it is in effect raising our bond interest expense. So that effective interest rate for us is $4,887. Basically, this is the way that when we discount a bond, meaning we get less money in the beginning than what we pay off in the end, that's how we make up the difference that our investors are getting from our bond versus what they could get in the overall market. Here we just have a table that shows the amortization of our bond discount. If you'll remember, we began with a full discount of $3,546, and we had that bond's original carrying value was $96,454. Every time we make an interest payment, we're paying $4,000. But our interest expense is going to be the $4,000 plus the amortization of our discount, which using the straight line method is going to be the same amount every period, $887. So our interest expense is $4,887. And we have therefore amortized $887 with this first interest payment. When we amortize our discount, we are reducing the amount of the discount. So you can see here our discount decreases by $887 and the carrying value of the bond increases. We'll do the same thing every time we pay interest, and you can see as we decrease, eventually our bond discount will be 0, and the carrying value of the bond will have come up to the face value of $100,000. You can see here, remember that the straight line method, we're going to have the same amount of discount amortization every period. If you see here, it's $2 less in this last period, and that's simply because of a rounding difference. It's not a big deal. You can just ignore that. But that's just a basic rounding difference. So the idea here is that as we amortize our discount will get smaller, and therefore we will raise the carrying value of our bond to its ending face value, and that's what we're going to be paying off at the end of the life of this bond. Now we're going to look at issuing a bond at a premium. The basic method is the same as what we were doing, but things are going to kind of work out the opposite way, and let's look at what I mean here. In this case, we still have the same bond. It's got a par value of $100,000, but it's being issued at a premium. That premium percentage is 103.546%. Again, we're over 100%, so it's a premium. Why is it a premium? It's because our bond is paying 12%, whereas the market is paying 10%. We have something better, therefore we'll sell it at a premium. What do we mean a premium? That means that we're going to get more money now than what we will have to pay off in the future. So we have the same interest dates, the same bond beginning and maturity date. So now let's look at issuing this bond at a premium. It's the same basic method. You take your par value, multiply that by the percent of issuance, and in this case we're going to get cash of $103,546. Therefore, the difference between the two in this case is a premium rather than a discount. So today we get $103,546. What do we pay off in the future? We pay off this bond's face value of $100,000. Just like before, clearly we don't balance, but in this case we don't balance on our credit side here. If you'll remember, if you want to go back a couple slides, you can. When we had a discount, we didn't balance over here. We needed something on the debit side, but in this case we need it on the credit side because the credit side is smaller, meaning what we have to pay off in the future is smaller than what we got today. So now instead of calling this a discount on bonds payable, we call this a premium on bonds payable. And this is simply, in this case, going to be an adjustment to our bond payable. Then we have the basic bond payable of $100,000. And when we include this premium, you can see now that we do, in fact, balance. Now again, just like before, our interest payment is going to be based on the original face value, but then our effective interest is going to be based on our carrying value. So let's look. Here we have the maturity value, we have our premium, and here is our carrying value. So let's look at what's going on here. We are going to be paying cash. This is the cash interest payment that's going out based on the face value. How do we calculate that? In this case, it's $100,000. We're paying 12%. Multiply that by half a year. So we're paying cash of $6,000. We also need to begin to amortize that premium. The premium was $3,546 over 4 periods. So again, the amount is the same, but this is a premium instead of a discount, so everything's going to be backward. So we're going to be amortizing $887 every time we pay interest. Again, when we're amortizing this premium, we want to get rid of the premium. We put this premium on our books by having a credit. So how do we get rid of this credit balance? We'll be debiting it. So to amortize this premium, we need to debit the premium on bonds payable. Here we had a premium on bonds payable of $887. The cash payment is $6,000. So in the end, our bond interest expense is going to be less. That is because this is a premium, and so our effective interest rate in the end is going to be less because we got more today than what we have to pay back. So it therefore is actually lowering our effective interest rate. So you can see here, to make this all balance, the interest rate, if you solve for it, is just $5,113. So here we just have the amortization table. It works very similar to the discount, but let's look at how this happens. We have our unamortized premium. We have our beginning carrying value. You can see here our interest payment is always the same, and we're going to be amortizing the premium by amortizing $887 every time we pay interest. You can see here our unamortized premium is going to decrease every time we pay interest, and then the carrying value in this case, rather than increasing like it did with a discount, it is going to decrease from our original carrying value down to the face value in the end of $100,000. In the previous examples, we've been looking at the journal entries for when we're actually paying interest through the life of the bond. But now what happens at the end of the life of the bond? This is our bond retirement, when we pay back the money that we owe and then the bond is complete. There's two ways you can retire a bond. You can retire it at its maturity date, so if it was a 20-year bond, it would mature at the end of 20 years, and that would be your basic bond retirement. On the next couple of slides, we'll look at what happens if you retire a bond early. And in that case, that might be that you retire a bond that was originally a 20-year bond at, say, 15 years. You can only retire a bond early if it's a callable bond, and we'll look at that as we move forward. But let's first look at our basic, typical bond retirement at the end of its life. You can see here if we had a bond. Remember, as you're amortizing a bond over the life of that bond, you are going to amortize a discount or amortize a premium until the ending value of the carrying value of that bond is the face value or the retirement value. So in this case, when we retire a bond, we're going to be retiring it at its face value because it would have already been fully amortized. There's no longer any kind of discount or premium. So if this was our $100,000 bond, we simply need to show the reduction of the bond payable. It's going to be reduced by the amount that is left over, which in this case is always going to be the face value because it's been fully amortized over its life. And then what do we pay back? We pay back cash of $100,000. This is your typical standard bond retirement. But then what happens if we retire a bond early? I mentioned that we call this calling a bond. You're calling it back before the maturity date. Typically, there is going to be some type of fee that a company has to pay in order to call a bond, and all of this is set forward in that bond contract. So if you have a callable bond, a company can call that bond or pay it off early before the maturity date. Now, why would a company ever do this? Typically, a company will do this if their bond is paying a good bit more than the market, because again, if you're looking at it from now, instead of the investor's perspective, look at it from the company's perspective. If we are paying 10% interest, but we could go out and just borrow from a bank at 8% interest, borrowing from the bank would be better. So we'll call that bond, pay back what we owe, and then borrow at a better interest rate. So let's look at how we actually record this. Now, if you'll remember, this is somewhat similar to if you retire an asset before the end of its life. You may or may not have some type of a gain or a loss, and we have to look at how the numbers work out to determine that. But in the end, if the carrying value is greater than the retirement price, you're going to have a gain. Otherwise, if the carrying value is less than the retirement price, you have a loss. We'll look at that as we move forward. But remember, if you retire an asset, a long-term asset, before the end of its life or even at the end of its life, you have to get that asset fully off the books. So remember, we had the asset, we had any type of depreciation that was still on the books. We had to take that off, the accumulated depreciation off, and then we had to calculate a gain or a loss or any cash that we get. This is similar. We have to take the full amount of the bond payable off the books. If there's any premium or discount left, remember this is not the end of the life of the bond, so if there was a premium or a discount, part of that's going to be left because we haven't let it amortize to the ending face value. So you have to get everything related to that bond off. You have to get the original face value off, the premium or the discount, And then you have to record what you have to pay to get it off the books. So that's the cash that we have to pay. So let's look at this example. We had $100,000 of callable bonds. So this is the amount of the bond payable that we're going to retire early. It's after the first interest payment. We're calling it early. The bond carrying value is $104,500. And the bonds have a call premium of $3,000. So first let's talk about what's going on. In the end, if we had let this bond go on to its retirement, it would have amortized from its premium amount. We know it was a premium because the carrying value is still greater than the ending face value. It would have amortized down to this $100,000 because this is all we have to pay back. Instead, we still have a bit of the premium left. The amount that's left is the difference between the carrying value and the ending face value. So we have a premium of $4,500. If you'll remember, when we originally book a premium, we do that with a credit. So to get rid of that premium, we're going to have to debit it. But let's look at what all's going on. We also have a premium that we have to pay on calling the bond. Now don't confuse this premium with the premium sale price of the bond. This premium is just like a fee that we have to pay in order to call it. And this fee would have been set forth in the bond's contract. So let's look at what all we need to do here. We need to take the full amount of the face value off. So we take the bond payable off of the books for the $100,000. We then need to take off any type of premium that's still on the books. You can see here the carrying value is $4,500 more than the ending face value. So that means the books still have $4,500 of the premium. So to get rid of that, we need to debit the premium on bonds payable to net that out to zero. So now we've taken everything related to the bonds off of the books. Now we need to calculate, what do we have to pay? We have to pay back the full $100,000, but we're also having to pay this additional $3,000 call fee. So we pay out cash of $103,000. You can see here clearly that these do not balance. So in this case, we're going to need a credit of $1,500. If you'll remember, credits mean that we have a gain. A debit works as a loss. So because this is a credit, we have a gain on bond retirement. And that goes along with our rules because our carrying value was greater than the retirement price, so we had a gain. Here our carrying value was $104,500, and the retirement price was going to be the $100,000 plus the premium that we're having to pay of $3,000. So in this case, the carrying value of $104,500 was greater than the retirement price of $103,000. Therefore, we had a gain, and you can see here, because in order for us to balance, we did need a credit. It makes sense that that is a gain, because anyways, gains are credits, losses are debits. So that's just a way to check your work and make sure it agrees with our rules. So that is your basic bond retirement. Now let's look at one other thing that we can do, and this is instead of going out and paying cash to retire a bond, you could also convert your bond to stock. And again, all of the rules regarding this would be in the contract for the original bond issuance. But in this case, rather than paying out cash to your bondholders, you're going to give them stock certificates. So you're still giving them something of value, but it's stock instead of cash. So on January 1st, we had $100,000 par value bonds that we are going to convert to stock. You can see here we're converting them to 15,000 shares that had a $2 par value. So we need to reduce the full amount of the bond payable. You can see here the face value and the carrying value are the same, so this was a bond issued at par, so we don't have to worry about any kind of a premium or discount to take off the books. So we have the bond payable being reduced, and then we're going to have common stock and then our paid-in capital in excess of par. We'll look more into equity and our different types of stock, but in this case, what we have to know is that we had a $2 par value. So $2 multiplied by 15,000 is going to go straight into common stock, and the excess, or the difference between 30,000 and 100,000, is going to go into our paid-in capital in excess of par account. So now we have converted to stock. So these are equity accounts on our balance sheet. So we have converted from a bond payable or a liability to now an equity where these people are no longer owed money, but they do have a stake or a claim in our business. We're now going to take a quick look at installment notes. Installments are different than your typical long-term note payable because if you'll remember, a long-term note payable, you borrow money at one point at the date that the note is issued. You pay interest as you go along, or sometimes you wait and you pay interest at the maturity date. But you do not pay the principal back until the end of the life of the note. On the other hand, an installment note, we are going to make multiple payments. So the basic difference is that a long-term note payable, we have one payment at the maturity date. An installment note, we're going to be making regular payments, and each of those payments is going to go towards the principal and the interest. Now, the best example that I have of a typical installment note that we all as people would understand would be like a car payment or a mortgage. If you look at your mortgage statement, you're paying the same amount every month. So let's say your mortgage is $1,000. That $1,000 is not going to fully go towards paying off your house. Part of that $1,000 is going to be your interest expense, and then whatever remains is going to go towards paying off your interest. So for example, if you make a $1,000 payment, you might be paying $250 of interest and $750 of principal. We'll look at how that's calculated as we move forward. But that's our basic difference, is that we have these regular payments of principal and interest. So you're paying it off as you go. So we can look here, we have an example that someone borrows $60,000 from a bank to purchase equipment. They sign an 8% installment note that requires 6 annual payments of principal and interest. So the way that we go ahead and record this is just like your typical note payable, cash, we get $60,000, and then we have a note payable of $60,000. Now because this is an installment note versus your typical note payable, there's no difference in how we record this. The difference is going to be when we're actually making our payments. You can see here there is a calculation for recording our payment, but we're not going to go over that in this lecture. We're just shown here that based on our calculation that our payment every month, or however often that you're paying it, in this case it's going to be 6 different payments, you're going to end up paying $12,979. Now, if you multiply $12,979 by 6 payments, you'll see that that's clearly more than $60,000. The difference between that and $60,000 is your interest that you're paying. The other portion is going to be your actual principal that you're paying off. So you can see here our beginning balance, what we borrowed is $60,000. Our cash that we're paying every month is going to be the same. I'm saying every month because I'm thinking about a mortgage, but in this example we're paying it annually. So our cash payment is going to be the same. The reason that we have installment notes like this is because if you think about budgeting purposes, it's much more easier for you to know what you're going to have to pay ahead of time so that you can predict for budgeting purposes your cash going out. So now we have to look at how is this divided between principal and interest. The first thing that I want you to note is to look at these columns B and C here. Column B is your interest expense. The first thing that I'm going to point out is you can see here in the first year we're paying a lot of interest. In the last year our interest has gone down considerably. And that's because, remember, your interest expense is based on what you owe. As we're making these payments every year, the amount that we owe is decreasing. Therefore, a smaller amount multiplied by our interest percentage is going to give us a less amount of interest expense for the year. On the other hand, what you can see here in this column is the amount of our overall payment of that $12,979 that is going towards paying off our principal. You can see that this is going to increase, and that's because as our interest expense decreases, the amount left over from our payment is going to get larger, and therefore that larger amount is left over to pay off the principal. And you can see in the end, we're paying off $60,000 of principal because that's what we borrowed. And then the additional portion, this $77,874, the amount over $60,000 is our 8% interest expense. So the way we calculate the interest expense was we would take $60,000, multiply that by 8%. It's for a year, so we don't have to worry about saying it's for a portion of the year like we were doing with bonds where we had to do it for half a year or 6 months. In this case, it's for a whole year, so it's pretty straightforward. $60,000 multiplied by 8% is $4,800, so that is our interest expense. The difference between the interest expense and our payment is $8,179, so that's this payment minus interest expense gives us the amount of our payment that goes towards our principal. So if we paid off $8,179, that means our principal is reduced by this amount. So $60,000 minus the reduction gives us the ending balance of $51,821,000. So that's our new beginning balance. This beginning balance is now what we calculate our interest expense from. So $51,821 multiplied by 8% gives us an expense of $4,146. The amount left over goes towards our principal and therefore reduces our carrying value, and this continues on over the life of the installment note. If you'll remember, we're looking at installment notes with equal payments here, so our payment's going to stay the same, and this is how we actually record that payment. So this is our first payment. We'll record the interest expense of $4,800. The note payable is being reduced by the amount of the principal that we paid off, and you can see here the total amount of our cash payment. You would do the same thing as you look forward. This is in 2016. We're making another payment. It's the same thing. Once you put together your amortization schedule, you've already done all the work. So as I mentioned, a mortgage is one of the most basic examples of an installment note, otherwise a car payment, because again, your car payment is the same, and then part of that payment goes towards your interest expense and the other portion pays off a bit of your principal every time you make that payment. Moving forward, we're just going to go ahead and define some of the features of notes and bonds. We're not going to spend a whole lot of time here because we've touched on a lot of these and they're simply vocabulary words you can read through in your book. I do want to touch on secured versus unsecured bonds. If you think about something being secured or unsecured, you're looking at the risk behind it. If it is a secured bond or note, this means that there is something standing behind it. An example is a mortgage. A mortgage is a type of secured bond. What happens if you don't pay your mortgage? The company can come or the bank can come and repossess your house. They have a little bit of security. Because a mortgage is a secured bond, meaning it has some type of asset behind it, this is going to give us a lower interest rate. That's why, for example, the interest rate you pay on your house is a whole lot less than the interest rate that you might have to pay if you just went out and borrowed cash without an asset to back it up, because with risk comes return. So the less risky, or therefore the more secure a note is, the less the risk, the less the interest rate. An unsecured bond would be if you go out and you do like a payday cash advance or something. You go out and you borrow cash that you have to repay. Typically, these are very risky because there is no asset that backs it up. They can't come back and repossess your house or your car. There's nothing to back it up. So that's an unsecured bond, and you're typically going to pay for that with a higher interest rate. We've already talked about bonds that are convertible versus callable. If you can convert a bond, you convert it to stock. If it's callable, you can simply call it. And remember, if you call a bond, you're just calling it back or ending it before the end of the life. Term bond and serial bond, term note, serial note, this is what we just talked about. Term note has one maturity date, whereas a serial note has multiple maturity dates. Then we can talk about registered or bearer type bonds. A registered bond is a bond that the owners of that bond or the people who it was issued with is actually registered. It's recorded somewhere. A bearer bond, on the other hand, is basically whoever bears the bond or whoever holds that certificate is assumed to be the owner. Just some little vocabulary words to be aware of. Finally, we're going to look at what we call the debt to equity ratio. Remember, debt is like a note payable. It is money that you've borrowed and you have to pay back. Equity, on the other hand, is that you have gotten money and rather than paying it back, you've given up ownership in your company. We look at the debt to equity ratio because it helps investors understand how a company is set up. If you're looking at investing in a company, you want to know, do they already have lots of investors that I'm going to have to share dividends and things like that? Or if you're looking at whether or not you're going to loan money to a company, you want to understand how many other liabilities do they have. If they already have a lot of notes that they have to pay back, you might think that they're a little bit more risky. You may not want to loan them money because there's lots of other people lining up to get their money. So it just gets a basic understanding of the setup of a company and an idea of the risk. We simply calculate this by taking the ratio of total liabilities divided by total equity. Riskier companies are typically going to have a higher debt to equity than companies with a lower debt to equity. When we talk about risk, we're talking about the fact that you may or may not get your money back from a company. And so the more promised amounts of money or the more liabilities as opposed to equity, the riskier a company is. Because remember, equity, you don't necessarily have to pay it back. That's simply giving up ownership in your company.